everyone. Welcome back to yet another episode of Reinventing Finance with my co-host, Tom. Tom, how are you?
Thank you very much. Fine.
And an awesome guest, Ian, from across the pond. Ian, it's a pleasure to have you here.
Thank you, Nick. Glad to be here.
Ian, for those of you, and I'm not one of them because I am actually an avid reader of your awesome blog. That's why I reached out. But for those of our audience who might not know you, why don't you briefly introduce yourself? Who are you and what do you do? What do you spend your time on these days?
Sure. So my name is Ian Gutterman. I have, I guess, a little bit of a maybe unique place in the insurance world, I guess. I spent about 20 years investing in insurance companies and got to know the industry that way. I started in the summer of 2001, right? So right before 9/11. So ended up obviously starting at an exciting time. I was at Fidelity at that time. So obviously had a big platform where when all those class of '01 reinsurers were coming public and so forth, they all wanted Fidelity to buy their IPO, right? So, I was able to really learn the industry to a large extent from the companies, right? So I had CEOs teaching me the business and wanting to help me, and I was able to develop a very strong network over time with leaders in the industry. And again, because I started at a interesting time, I kind of fell in love with insurance, I guess, and decided that's what I wanted to do for the rest of my career. So I sort of had this unique perspective where, I was able to sort of be maybe much deeper in the industry than a normal investor would. But obviously was always an outsider, not knowing it as well as a true executive or an operator would, right? So there's always this, over time, I guess I would say, this tension evolved where I felt I was more interested in why companies were doing the things they were doing and, why they couldn't see what I would sometimes see, which is, this change was happening in the industry and it was going to be bad for this company. And how come I could see this, but the company couldn't see it, right? And so over time, I guess I got a little burnt out on the investing and more interested in, wanting to be on the other side and try to, have some kind of more direct impact on the industry. And that was probably a good 10 years ago. And it was just sort of, when would I do it? And when was I confident enough to go do it and to leave the old career behind and make that change and all that? And, I guess 3 years ago now, I finally pulled the trigger and decided it was time to, walk away from investing and figure out how I was going to go make this transition. And, at the time I would have told you insurtech was very, very low on the list. I've been as if you read, I've been an insurtech skeptic from the beginning, and a skeptic of, I'll say, the underwriting insurtechs, right? Because it really is very different. I'm sure we'll get into that, but skeptical of the bigger name carrier-centric insurtechs, and didn't think, oh well, why would I want to do that if I don't believe in these models? And as time passed, I think what it led to was, especially as I started writing and becoming sort of known as being more skeptical, sort of getting challenged to, well, how would you do this? And then one thing led to another. And kind of, as I said, I've always been sort of the person who's had this ideas of, why can't we do it this way? Why couldn't we do it that way? But also having, the knowledge and the history to know what's realistic. I mean, that's probably, if you're really to simplify it, the big thing that I add, right, is I know what's realistic and what's not, right? So the people who come from truly outside the industry and think they can go change everything, and all, these insurance companies are so dumb, why can't they figure this out? I know which things really are things that the industry should do better and which ones sound good in a pitch deck, but just are never going to work, right? So that's the advantage that I hopefully bring.
So,
So that kind of led me down this path of, I think I have a different way of doing this.
so before we go into what it is that you're currently doing, I
Yeah,
think
sure.
there were
Yeah,
three very interesting things you hinted at that
yeah,
I would love to get a little bit more
yeah,
flesh
of
on the
course.
bone. So from your time as an investor, maybe
Yeah,
one or two things, which advice, if you can, and you can
yeah,
make it as generic and specific as makes sense, would you give, let's say, an incumbent CEO that you feel could be relevant to them, that they are missing, or
sure.
one of the, and let's talk a carrier-centric
Yep.
insurtechs. What, one or two things where you just kind of go, guys, this would help you. You know this.
Right. So I mean, to be honest about it, like some of these ideas that have become informed were things that I went to, and I won't name names obviously, but I went to, major carriers, 5, 10, maybe even more years ago. Again, as an investor with a position saying, hey, why can't you guys try this? And getting stonewalled, right? So
Give me an example.
yeah, sure. So that's what I'm saying. So like I know the industry is it's just very hard to get these guys to change. And again, because I focus, it's not just personalized. Obviously, there's plenty of things in other parts of the value chain. But I've always had sort of a special interest in personal lines, I guess. And it's just basic things like you know, it's just very difficult as a customer to really get what you want, right? And the industry has, gone so far from, you know, I'm going to try to make this not a super long answer here, which I tend to do. So if you go back over, the decades, right? The how the big guys became big in the first place, right? The State
It's
Farms and
not
the
a good
Allstates, the
start.
Farmers. I know, I'll
It's
do it
not a
fast. I
short
can do it fast.
answer if you go
Exactly.
back on the decades.
I know, but I can do it quickly, I think, which is they were known for protection, right? All those taglines, right? About, what did all those jingles mean? Those jingles were, we'll take care of you if something bad happens,
Sure.
right? And what happened when Geico and Progressive came along and made it more price centric, the big guys kind of moved towards being price centric too, right? So everyone's giving this price message. And no one's there saying, what happened to coverage, what happened to protection, right? So so that was a big part of it. And then the other part is just sort of efficiencies, right? So I will give you one that I wrote about, maybe a couple of years back. If you're one of the big established guys, do you really need a bunch of captive mainstream agents and small offices across many states? Right? Again, I won't mention the carrier, but it's for all the big guys. I live in a suburb of Chicago. I think I had, the last time I checked, again, if you go to one of the top 3, there were 15 agents within a 10 to 15 minute drive of me. Why? Right? Why should there be that many? You don't need that many agents. It's just because that's how it worked, right? Back in the day when there was no internet, you needed that, right? You don't need that anymore, and yet they still operate that way, right? So how do we evolve distribution to say we still want a personal touch and we still want to be able to give you better service than just going and doing a couple of clicks, but it's inefficient to have all these local points of presence. How do we centralize that more? And change the model, right? So there's lots of things you can do. But it's, a lot of it is not, it's not that I'm this brilliant person who's the only one who's come up with these ideas. These ideas have all been around. The issue is the incumbents are just very hesitant to actually act because they're worried about the disruption, internal disruption.
And so what do you take from that? What advice would you,
Yeah.
is that, so to kind of, would that be,
Yeah.
dear CEO of an insurer with captive or tied agents,
Yeah.
don't throw away, personal advice works, but do they have to be physically located with the square mile radius? Because do people need physical advice with a face-to-face physical interaction, or is it just personal? Is that one of the advices? You know, is it like streamline?
That's certainly part of it, right? That you can certainly streamline that, right? You know, there's certainly lots of things on product, right? You know, the way, and I'm going to sound self-serving, so we'll probably talk about this later about what we're doing. But again, everything we're trying to do at Inform came out of frustrations I had, right? So I feel most insurance companies start from a mindset of, we want you to buy this product. How do we convince you to buy it? Right?
Mm-hmm.
Rather than saying, some people might want this exact product, but other people want other things. How do we help the other people who want other things get what they need to? Right? It's always, this is what we have for you. How do we convince you you should buy what we're selling? And that's, you know, forgetting insurance for a second, just looking at the broader, you know, economy or retail or whatever, that just doesn't work anymore, right? If you try to force somebody, if you're, and you know, I'm going to use a US centric example, so hopefully this will be relevant, but you know, if you're someone like Sears, right? Like, how does Sears make their name back in the day? Is they had their Kenmore brand and the Craftsman brand, and they would try to sell you their own in-house brand over the generic one, right?
Okay.
That doesn't work anymore. There's a reason Sears is basically out of business, right? Because people want choice. They don't want to be told what they should have. And insurers still tell you what you should have.
So what's the solution then? So where do you, so let's say single carrier, limited product choice with this strong physical proximity, which drives up admin costs. Okay, that's right? So where do you think there is room for improvement, and how does that translate into, you know, becoming an insurtech skeptic towards, let's say, an insurtech operator? How does that work?
Sure. So, I mean, it's, you know, again, I guess part of the different mindset I have coming from an investment background, right, is while I specialize in insurance, I certainly saw things that happened elsewhere in other industries, right? So I've seen other business models rather than just insurance, and I did some others for a little while. So you have sort of a different perspective on what it means to be customer centric, right? And that's something this industry is just very poor at. And, you know, even the new insurtechs that they address pieces of it, right? Making it faster, making it, you know, making it simpler. They're all pieces of it, but they're not really the solution. To me, the solution is people have very different needs, and people want to buy something that's personalized to them, right? And the ability to really personalize your insurance, you know, is just something that insurance hasn't done yet, right? Other industries, lots of other industries, we can come with lots of other examples where this has happened, but not in insurance.
And so, what's the solution, and also what's the, I mean, you know, what's the actual next iteration of betterment, right? Rather than, hey, this is how, you know, I think there's lots of, I mean, Tom and I've been happily going to all of these insurtech events, and you know, I was there's the one policy and one to rule them all, and everything's data driven and blah 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 blah, right? And it's like autonomous vehicle. It's like, okay, great. I get the 20 years, right? But give me the 3-year plan.
No, sure.
You know, what do we? Because I think that makes it somewhat tangible. Because otherwise, it's very disconnected, at least for me, and maybe for one or two listeners as well.
No, sure. So, you know, and again, we're focusing on homeowners, so we think there's more. You know, if you were sort of to draw a you know, bell curve of insureds, right? If you're talking about something like auto or, you know, motor, most people's needs are fairly similar. Some people might need more limit than others, right? But the coverages you need are fairly similar. In homeowners, there's just people have, you know, the people who are sort of in the center of the distribution. So again, I'm going to make these numbers up, right? So maybe for auto, 85% or you know, within one standard deviation and there's only a few people at the tails, right? In home, maybe it's a third are in the center of the distribution, and there's 1/3 on the left tail and 1/3 on the right tail, right? There's just a lot more disparity of personal needs based on where you live, what your income is, what kind of house you have, all sorts of things, right? So, you know, and a simple example I give a lot of times is, you know, if you have call it $1 million home in a major city, it's probably, say, a condo, right? A condo doesn't have, you don't have a backyard, you don't have a swimming pool, you don't have a fence or even your own garage, right? Where if you have that same $1 million home in the suburbs, it's twice the square footage, maybe 3 times. You have all the, you know, you have all those things surrounding you, right? The yard, maybe the pool, maybe the trampoline or whatever it is. You have different weather risks, meaning, again, if you're in that condo, you might not even have a roof, right? The roof might be the person who's in the penthouse. If you live in that standalone house in the suburbs, you have the roof, right? So there's all kinds of different characteristics people have, and yet we sell them all the same policy, right? Basically, right? So the idea is, why can't we have customizable policies where if I need different types of coverage than you do, I can buy that, right? Rather than just saying, hey, I'm State Farm, I only have sell one policy, this is what it has, take it or leave it. You can still adjust dollars within something, right? You can say, I want more coverage for liability, or I want a different deductible, but you can't sort of, you know, pick and choose what you want to get what makes sense for you. So you end up overinsured for some things, paying for things you don't need, and you end up underinsured for other things because I have risks that don't come in the base policy and I can't get coverage for that, right? So it's kind of like an ill-fitting suit, right?
Yeah.
I want to give you a custom suit, and you're forced to buy whatever suit we have left, and hopefully it fits you a little bit.
And I think that's, and you know, Tom, please correct me if I'm wrong, but I think that, you know, one advent of technology is, or one of the reasons why insurance product had to be simplified is because they were sold through people. And in order for people to reduce, you know, it's basically the difference between the risk model and the tariff model, right? It needs to be something that is explainable. An actuary, they would know how to price all kinds of things, but it would be very difficult to explain, to direct to the right customer segments, and quite frankly, also it would take too much time because the counterparty might not actually know. They might not actually know what's in their walls, right? You know, people might not know, and so it would then be overload. Now, I don't think that has changed because you still have the end consumer and they might not know. So I guess my question is twofold. One, how do you actually get to the customer? Because to me, that seems to be the biggest problem with insurtech, managing customer acquisition costs, especially as you try to manage venture-backed expectations of growth. I'm talking 100% year over year with underwriting profitability, which, you know, they're kind of two opposites. And the second thing is homeowners potentially, have you identified certain public, private, proprietary data sources that will allow accelerated underwriting or more accurate underwriting without putting more burden on the policyholder? Because I do not think that has changed. I don't think that, So maybe those two.
Sure. So I'll do the second one first, just because it's the easier one, is there are now, it may not be proprietary, but there are vendors that will sell you all the data you need to customize the underwriting. And it's kind of, while some of the insurtechs want to tell you they have these proprietary underwriting systems, and I'm sure they have on top of the base models. But any startup that wants to, frankly, can go buy these underwriting
Verisk,
models.
Hazard Hub,
Exactly, right? You can go buy all this stuff now. So, and it's all very good, right? So there's no need to necessarily try to recreate it. So the tools are there to do it. The insight, frankly, is more, what do you put on top of it and how do you use it? But it's not necessarily hard to get the tools. So that's one piece. The acquisition piece is clearly the main piece, right? And to that point, this is the kind of model I'm describing really does require it to be online direct, right? Because, as you said, we can't go train the agents to go think, I have 32 different models, policies I can sell, and now I got to be expert in each one of them. That's just not going to happen, right? So it's got to be the computer essentially is managing that rather than lean on the human. So that's one part. So, and just furthermore, the ability to understand what a person needs is going to be AI driven, right? So again, you're going to have to do this direct. And then to your point, the people who have gone so far have struggled going direct because of this tension of, I've got to show all this growth. So I end up, overpaying for bad customers, basically, right? And if you're going to do direct, the biggest lesson I learned from Progressive over the years. So what's ironic is Progressive has spent the last, 15 years trying to move up market because they realize the economics are, if you're going to do direct, you got to have better retention, right? I don't want to keep paying this one-time fixed cost and then lose a person after a year and pay this one-time fixed cost again, right? So they've been moving up market because they realize I pay the one-time fixed costs and I keep the person for 5 years. That's fantastic, right? So if you're going to go direct, you should be trying to go up market, not to the lower end of the market. And that to me was a big mistake that the guys who have struggled made. So if you're going to go up market, and I'm not saying true high net worth Chubb, because those people are probably too complex or want too much advice to truly do online today. But there's sort of a level below that between that, what I call that middle of the distribution cookie cutter policy person and someone who's all the way up at a high net worth, where they need more help than average. And they're, technically savvy enough to be willing to answer some questions and get some, and not be put off by computer advice, if you will, rather than a personal advice, where there's the ability to have that different kind of experience. An acquisition of them, and that's a whole separate story of what we're going to do to acquire them, which we can get into later. But that's essentially the idea, is if you can get those people to, there's a community of people who are being underserved that are digitally savvy and would be willing to interact that way to get more choice.
So I think that's the critical element. So I'm pretty sure that everyone, if you take the entire market, that people are not perfectly insured from their current and evolving risk exposure, and what an actuary with a portfolio would know what someone should buy cover for or not, right?
Yes. Yep.
Now, what the evidence that we found in Germany, for example, which is an interesting market, strong independent brokers, strong tied agents in the retail space, strong price comparison side, reasonably strong bank assurance, and so all kinds of channels, so very mixed. And what one found is, and I don't have the numbers in my mind, but let's say maybe 10 to 15% of the market is actively looking. So with direct, you normally get. Now, what we found, what one found is that the problem for the insurer is twofold. Number one, they're much more price sensitive and much more competitive. So the loss ratios, just in terms of premium for coverage, are lower than a comparable commissioned customer that keeps its policy for 15 years and never calls you up.
Absolutely.
And by definition, these are more active and less loyal customers, because if they'll go through, and it doesn't just have to be price, it can be brand or someone else.
Sure.
They switch again. And so you'll get the worst of both worlds.
Yes.
Having said that, there's also examples over long period of time. Hook, it's the largest car insurer, but it only works really well on cars, because people buy and sell cars. So there's a natural tendency of reviewing your insurance as you'll change your car, I don't know, every 7 years or so. They've gotten incredibly good numbers because they don't have ongoing commission, which on auto is like 6 to 12%.
Right. Sure.
But how do you fix that, right? Because you're getting price sensitive, disloyal customers. If you put something on Google, if you put something on Facebook, or I don't know, Tom, your TikTok channel, then you're in the discovery phase, and you'll get this advert whilst you're boarding the bus. Wait, I don't want to buy that insurance. So how do you actually get to those customers who, by the way, might be either they're already insured, right?
Yep.
So you even need to switch them away. And I think that is where a lot of money, investor money, has been allocated without the expected returns over the last 5 years.
Yes. So what you described is I completely agree with, right? Is and it led to a lot of the mistakes that we've seen made with the public insurtechs. And you can imagine I've thought a lot about this issue. And
what can you share?
Right.
What secrets can you share?
I don't know that I have the secrets. I have a different path. We have to prove this other path will work, but it's a different path. And the idea is, if you're trying to get the better customers, you need to do it through information and education, right? So if the lead is not, hey, go save another 10%, if the lead is, you probably have the wrong insurance and you don't know it because no one's explaining this to you. Come find out what you're doing wrong, right? That's a very different message than what's in the marketplace today. And if we and it's going to attract a different type of customer, right? The people who will respond to that, you're right. The people who shop frequently and just want the lowest price won't respond to that, but we're actually okay with that, right? We're not necessarily looking to get those customers, right? We're trying to get those other ones who say, I don't want to respond to, I hear all these, save 20%, and I just tune them out because I actually care more about, will my policy pay when something bad happens, right? I want to reach those sort of people because they don't have a voice right now. They don't have anyone reaching out to them. Kind of what I said earlier, the majors who built their brand on taking care of those people have changed all their ads to be about, we have low prices too, right? Okay. So even if you've been with one of those big guys for 10 or 20 years, you kind of feel abandoned, I think anyway. They don't respond to you anymore. So if someone new comes and says, we're going to show you what you've been missing and how to improve your policy. And by the way, it may not cost anymore, because what we might be able to do is say, you're paying too much here, you're paying too little there. We can take away this coverage you don't need, add some coverage that you really should have had and no one told you about, and we can keep your price flat. Do you like that? Right? Okay. That's a very different market, and you reach them in a different way. You're reaching them through, essentially more of like financial advice type approach, personal finance type approaches than true come shop with us today at Informed, right? Because we have low prices too, right? So it's a very different message. It's worked in certainly many other industries where people have, built brands around being seen as kind of the trusted brand, and then gone on to be able to sell product, rather than just be another cheap online channel.
Now here's, and I get that. And I think that that message is, I think it's clear. Now, my question about that, does that necessitate cutting out the middleman? I mean, I understand that you have a channel where you have fixed customer acquisition costs over a longer time.
Sure.
But ultimately, when you're saying computer, AI, I mean, ultimately, someone, the end consumer, the agent, some form of data upload has to feed some form of information, which you'll then create proxies, enrich to feed your model, right? And have the AI or, whatever run it. That could also be, why not go to an agent who possibly has a trusted network of clients, for better or worse, because going through an agent, going through a person is actually really good UX if you don't want to deal with something.
Sure.
Right? If you can then trust that person, etc., and you need to know what you're paying for. But why not make it much easier for the agents to then advise on something? Then, it means that it's not 5 data points, and not every single condo is going to churn out, I don't know, $650 or something. The price will vary. Fair enough. But you could still run that through a trusted advisor. Why cutting them out?
To be honest, it's actually something we've thought about. Our mantra, if you will, is we want insureds to get the right coverage for them, and we don't care how they do it. So, like, one of the things we talk about is, and one of the things, frankly, we even suggest you do on our site is take this information. If you find it helpful, we don't, again, kind of what I said in the beginning about how insurance companies want you to buy only the one thing they offer, right? We make very clear, if you found this information helpful and you want to take it back to your current insurance agent and still buy through them, that's okay. We're not going to stop you, right? What we have faith in is that enough people will find what we're doing valuable that they will choose to buy through us. But we're not going to try to force someone to do it if that's not what they want to do. We could debate whether that's leaving money on the table or not. My view is, and this gets back to sort of what you're talking about, the VC approach and growing recklessly and all that. We would rather leave some short-term growth on the table to build a brand that long-term will serve us better. So one of the things we've thought about actually is there may be an avenue where we do work with agents, because there are plenty of good, we had a conversation with an agent the other day about there are really good agents out there who agree with what we're trying to do and would like to be able to offer their clients the type of information we're talking about, but they just don't have the time to do it, or they don't have the time to find out what percentage of their book cares, right?
Yeah.
So if only 10% of their book's going to care, to figure out which 10% it is time consuming for them. We might be able to be an intermediary there, where maybe the agent would say, I'm going to send your information to all my clients, see which ones respond. I'll pay for the advertising, essentially, right? Instead of us paying for it. And we're essentially helping them figure out which part of their book needs more attention. So there's lots of different ways we can go, right? We're not trying to say agents need to go away and all agents are bad. What we're trying to say is people need a better experience than they're getting today. The constraints of the system don't allow most agents to really understand what a customer's needs are, and therefore they're getting a suboptimal solution.
And so, okay, so you go around education. You don't come with a price positioning, cost. You say about adequate coverage, and you're open for direct and an intermediated model, because ultimately the customer chooses who they want to kind of
Yes.
buy from. But the main
Yep.
point is getting the right insurance rather than getting a cheapest product that might feel good or
Yep.
feel secure, but then in the advent of a claim doesn't protect you adequately.
Right.
Now, maybe in your point of view, if you've kind of, and we're recording this late January 2022, there seem to be public insurtechs on a carrier model. A lot of them listed, quite frankly, in the United States as well. But my Zhong'an stock is not performing that well. I mean, my wife is telling me, "Why the hell did you buy this company?" It's really bad from IPO. But why do you think public markets are pushing insurtech carriers? Why don't they find it that interesting anymore? And is Root, Metromite / Lemonade, are they all the same? Do we need to differentiate? Is there a common theme? And what does that mean for VCs and other insurtech founders who want to get VC funded and growth? And so how can you walk us through that? What's going through your mind when you read about this?
Sure. So, I've been very public saying these companies, sorry, didn't mean a pun there, that these companies went public way too fast. I've written that, a few times. And the reason for that is, again, this is where my investor background maybe comes in and gives me a different perspective. To me, as a financial, it's different if you're a true tech company. As a financial, it is very difficult to be a public company if you are not self-funding, right? I mean, REITs are probably the only exception that has been able to pull off that model. And even they had trouble at times where they always need to, because they have investors who understand they always need to raise more money. But most financials that are public and have questions about future capital raises trade below book. That's just how it is, right? I mean, if you go back to the financial crisis, why did all the companies that needed bailouts need bailouts? Oh my God, they're going to need more capital. That's always the thing that investors panic about is what if there's an unanticipated capital raise? So to go public while you were still having huge cash burn was just a giant, giant mistake. They should have stayed private longer. We can debate what the motives are and why they did it and whatever it is, but it is what it is. They all came public way too fast. So my advice to the guys who are sort of the next wave and, are in their whatever Series C stage is don't be in a rush, right? Like you need to have a model that lets you stay private until you get to the point where you're self-funding. And the hard part about that is, and this sort of gets to the other piece of it is how many of these models have a reasonable time frame to being self-funding, because that means you're making underwriting profits, not just on a technical basis, but that you've also gotten your expense structure at a reasonable place, right? So we're a long way from that on most of these companies. But realistically, I think that's what you need to show. You need to show, forgetting all these like adjusted garbage metrics, to me, it's, let's just go back to basic things like technical ratio, right? Show me a profitable technical ratio. And then, then we could deal with the other stuff, right? And, then we could talk about being public. But until then, it's a very risky thing to do. And the other thing that I've talked about in the past is, the biggest disadvantage about public markets is there are people who can short, right? People who are negative can act. In private markets, people who are negative can't act. All they can do is say, I don't want to buy this round, but they can't make the price go down, right? Once you get into public markets, someone can say, I don't believe in your story, and I can make the price go down, right? So that's a very different thing that I can understand how the founders weren't market savvy enough to understand that. That's okay. But to be honest, their VCs let them down. The VCs should have known that was a big risk and kept these guys private for longer.
But the VCs also wanted to do the IPO
Of course they did,
to
but
get their
they
money
had to
back.
understand the risk of it.
Yeah, but if you IPO the company you're invested in and you have your money back, then you don't care anymore. But that's
If they exited, right? If
yeah,
they
yeah,
exited
but
on the IPO, yes.
that's what they
Do you
often
know
want.
how many? What's that like in the insurtech or general space? I don't actually know. I thought as well it was like a big insider Ponzi scheme, and people cashed in, and then afterwards, other parties had to do. But when you're structuring an IPO, I've never been part of that process. Does it actually mean that, I don't know, SoftBank kind of comes in, it's like, yeah, invest, and they're like, yeah, but you keep, you cannot sell out the same way, founders, or if management kind of goes, whoo, I'm gonna cash in, that's bad signaling. So is there certain holding
Exactly.
periods that you need
Yep.
to take, because to protect public investors, because they're not just going to go, wait a second, you're out?
Yes. Exactly.
Right.
Right.
Okay.
So I need to go back and look. I had this on my list to go look this up, given recent events, how much it's all disclosed in the IPO documents. I don't remember the numbers, but if you made me guess just from past experience, I would say most of the VC firms probably sold a small percentage of their stake, but held on to the large majority because of that issue, right? It is IPO investors would be like, I'm not buying this deal if SoftBank's getting out, forget that, right? So they're kind of locked in, that they end up selling down whatever, 20% a year over the next 5 years, something like that.
Okay. I mean, that kind of makes sense, right?
Yeah.
Okay, but that's also
So,
why an IPO is often seen as, let's say, a difficult thing, because it's sometimes it's not a real exit. So you better sell your company, because then your exit, you have a real exit. But let's say I mean, there are, I think, two problems. There's just too much money around. So doesn't matter what it is, real estate, art, cars, it doesn't matter what it is. There's just too much money, and it has to go somewhere, and then valuations go up. The second thing is that the idea of winner takes all logic of software companies has been used to explain that all the other industries will follow the same path, which is not the case. So, I mean, if you just take old companies like Facebook, or in the COVID crisis, if you take Zoom or Slack or this kind of software companies, you could argue that in the beginning you don't have to be profitable, because at a certain point you reach enough people and then you're break even, and then beyond that you're earning an enormous amount of money because you don't have any additional costs, because it's software, so to say. But when you go back to stuff which is pretty basic and normal, then in the end it's always about revenues and cost, and if you're profitable or not.
I learned that in business school.
And this I'm a historian, so that's in the end, at a certain point it always comes back to that point. And as long as investors think that you will reach this state, or somebody else will believe, and you're early enough to sell your shares, then the world is okay. And then you have a turning point, and then it goes the other way around. And then people say, I'm not quite sure if this company will, let's say, will succeed. And then the sentiment changes, and then you have a crisis. And that's also, it could be even in this week, where for certain companies shares go down, and it even doesn't have anything to do with being profitable. So if you have a high PE ratio, and you have a very high price of your stocks, and people say, this price means that the company will grow the next 10 years 50% every year, and then it doesn't work anymore like that, and it doesn't grow 50%, but it only grows 25%, which still is pretty okay. But then you go, let's say you can just take your Excel sheet and then see what happens if your expected growth is not 50% the next 10 years, but it's only 25%, and then it has huge
Right.
influence on your PE ratio, and then the stock goes down again. So, but that's typical for nearly, let's say, any cycle. And then if you are on the maximum of a kind of cycle, then everybody's discussing when will be this happening. But if you just would see the amount of dollars invested in the insurtech space, and you compare this with the total revenue in the intech space, and you would say, okay, all those investors have to get tenfold their money, then the question is there as many revenue around to make this happen? And the answer is it's a rhetorical question. The answer is no, it's not possible.
Exactly. So, I mean, one of the advantages I have, right, is I started investing professionally in '99, right, during the tech bubble. And I saw how the tech bubble
Matrix
ended.
came
I lived
out.
it. Yeah,
I think
that
was
too,
nice.
right? So I lived the tech bubble, and in an alternate universe, I was offered the chance, before I started on insurance, to do telecom equipment, and I said, rather wait for insurance. That's how crazy I am, right? But it was actually the right decision because they were all going to zero, right? I also know what happens after the end of the bubble, right? So I mean, that's kind of, that's been part of the strategy of what we're trying to do differently, is to know, I had no, false delusions of grandeur that we were going to get far enough along in our business model to still be in the easy money phase, right? By the time we're ready, this was all going to be over. I couldn't tell you when. I didn't know that it would be January of 22, and maybe it's not over yet. Who knows? But I knew it would be over, and we needed to have a plan for the rebound, right? So that's always been in the back of my mind. But you're exactly right. We basically had a bubble, and I know lots of people. This isn't how I was good as an investor, but there are lots of really good traders that might know they're in a bubble, but are good at entry points and exit points and can make their money. That's easy if you're trading public stocks. Easier when you're a VC and you don't know when that company's going to come public, or if it does, you're still locked up and you can't sell it too fast because it looks bad. You don't have the same liquidity that a hedge fund trader does, right? So you run the risk of getting stuck. And that's basically what happened. I'm sure some of these VCs knew, and I won't name a name, but so-and-so wasn't worth whatever, $5 billion that they were at the peak, that didn't make sense. And they were hoping they'd be able to get out in time. And because they were in an illiquid position, they couldn't get out in time, right? So it doesn't mean that they drank the Kool-Aid and thought everything was going to always work. I think some of these guys were more practical and probably figured they'd be able to exit before the music stopped, and it didn't work out.
So what does that mean for anyone else kind of following up? So what is some advice in terms of, do you even need to worry at seed or Series A? What advice would you give? Because as an entrepreneur myself, you tend to underappreciate financial market sentiment, simply because you have your operating business to focus on, and but that has a huge impact on your valuation and access to funds. So what advice would you give anyone in the trenches?
I mean, raising money is going to get harder, right? I don't even mean just the absolute valuations. They'll clearly will come down. But just raising money will get harder, because I'm sure we will get, why would I invest in another personalized company? They don't work, right? So you have to get past that to explain why we're doing it differently, right? So that will be one issue. And I would say the biggest issue, and this goes back to the tortoise and hare stuff and some of those other articles, is you need to show that you have a plan to end your cash burn. I can show you in our financial projections are obviously very speculative at this point. I won't say anything otherwise, but they at least account for the fact of, this is how much total capital we think we need until we're self-funding, until we're cash flow positive and don't need to raise any more money. right? I think companies are going to have to start showing metrics like that, as opposed to how big is our market, how fast can we grow, and don't really worry about how much it's going to cost to get there. I would also say, I mean, back to the question earlier, part of the reason these companies came public is because they used so much cash to get to where they were, that I think some, I mean, I don't know this is a guess on my part, that some VCs kind of must have felt like, do we really want to put another $1 billion into this thing to keep it private, right? Like it's, you know, it gets back to sort of, Tom, what you were saying, that, you know, one of the other differences versus winner takes all is, even if it were winner takes all, to get to winner takes all that growth has to be funded. You don't just have to fund your losses like a normal software business. You have to fund the stat strain of the growth, right? So you have a double capital call, and it's actually destructive to grow too fast because you need more and more and more capital to grow faster and faster, which then leads you to being forced public too fast, right?
So maybe, because that was one of the things that I never got in my head around. Why do VCs favor the fully licensed carrier model at the expense of the MGA or MGU? Sure. Why is that? Because the MGA doesn't, I mean, you know, maybe the UK, as you know, I think you need to keep, I don't know, 1 or 2% or something. Sure. But for most, you can structure, you get a nice commission, you can structure a success fee, you can build everything that you need in terms of customer acquisition, underwriting, branding, even claims, that differentiates you without the capital strain. And in some cases, because if you find a good and flexible reinsurer or primary insurer, even benefit from his or her portfolio effects. So why that push towards a carrier and a license? It just seems so burdensome.
I think it depends on where you're playing, right? So again, the guys who came first started in personal lines where, you know, there's a lot of cat, right? There's, I would argue over time a need for a real rating. You know, there's other regulatory factors that make it hard. You know, certainly the guys who started, most of these guys started as MGAs, right? And you'd use some front or whatever it is. And those types of solutions have limited capacity, right? So if you're really trying to be a $10 billion personal lines, you know, top, you know, premium company, forgetting even the reinsurance capacity, is there enough, you know, just, you know, admitted paper capacity to write for you, right? So it does get difficult. At some point you have to go full stack. And I think the other issue is the VCs like the idea of being able to deploy bigger capital than an MGA would. On the other hand, if you see like I think we would say sort of the hotter private names now are all these cyber MGAs, right? And, you know, unless, you know, whether they work or not is to be seen, but they're MGAs, right? Because why would we want to go put cyber on a balance sheet? Let's go send it off to the guys in Lloyd's and let them deal with it. So certainly markets, you know, I think there's been an evolution to that being a preference. It still does have flaws though, right? Like people act like MGAs are you know, the secret answer, and it's not that easy. MGAs have more tail risk, right? Meaning you have a bad year or two underwriting, your reinsurers are all going to walk and you're dead, right? So again, that happened in the 90s, right? It hasn't happened for a long time, but it does happen. So I think the way I tend to say it is really it's capital light is what you should be targeting, right? MGAs are the simplest, most common way to do capital light, but you can do capital light with an admitted balance sheet. You just have to be smart about using reinsurance and you know, there are other things that can be done. I mean, there's plenty of tricks if you know what you're doing to make things as capital light as possible. And by the way, that doesn't necessarily mean a reciprocal. That's a whole other conversation. But I think reciprocals like MGAs sound good on paper, but they do have risks to them that tend to.
Could you explain the difference just in terms of terminology?
Sure. So reciprocals are kind of the new trendy thing in the States, because you're essentially having they're similar to a mutual, right? You're having your customers essentially put up the funding.
Okay.
Right. And the idea is, oh, this is great. The customers are putting up the funding and we are a management company who just gets paid a fee, similar to an MGA, right? But as opposed to, trying to get an E&S carrier that's going to provide capacity, I get my customers to provide capacity. And that can work. USAA is a reciprocal, Erie is a reciprocal. They're very good companies that are reciprocals that have done very well. But I feel it's very prone to abuse. A lot of the Florida only homeowners guys have used reciprocals as a way of, getting themselves fat MGA fees and having the customers overpay. So it definitely can be abused. And again, to sort of what we believe in, the customer is taking undue risk that they are not being told about, right? There is a capital call. If there is a bad catastrophe or you're just a bad underwriter or whatever it is, and you need more capital, you're not going to your customers and saying, give me more capital. Customers don't understand that. Very, very, very few do. Someone like Pure, who's done that in high net worth, where they have very, affluent customers, maybe they do, so that I get. But if you're just doing it to mass market, those people don't understand what they're doing. And I think it's a very dangerous model that has a lot of regulatory risk.
So, like Digital Lloyd's names.
No, it really is. It is. It's very much like names. But again, all these things are just different ways of doing the same thing, right? So, again, trying to be capital light certainly makes sense. But the issue is a lot of these VCs aren't sophisticated enough about insurance to know the flaws. So when someone says, "Oh, an MGA works great" or reciprocal works great, they don't know what the downsides are, so they think it's a great model.
But it's also, let's say, we in this kind of phase, and you also had it in the end of the 90s.
Yeah.
When there is too much money for too long time, then you're out of balance. But the question is, who understands this? And you have this very well-known quote of Buffett, who says, "When the tide goes back, you can see who has a swimsuit or who's naked." And we don't know at the moment. And then the other thing is that the VCs, you have two possibilities. They know exactly the game they are playing, and they are just will be in time. And then the other one has, let's say, the difficult shares. Goldman is excellent in doing this all the time. And we have seen this again and again. And if you just zoom out and you take other business models, like at the moment, those 10 minutes couriers where you order one cucumber and somebody comes by and you just pay the normal price in the supermarket, everybody understands that's not a business model. But if you just see the billions which go into those companies, nobody can really explain me who has a VC background that this is a business model which be on a long term will be a profitable one. But why do those companies? So just zoom out of something which is more complex, like insurance, to you order a cucumber and then somebody comes by.
Right.
And they do capital rounds of $1 billion.
Yes.
So I just think we have to accept that it's a very differentiated field we are in. We don't know who is naked and who is not, to quote Buffett. And in the end, it just takes time to see what will survive and what will not survive. And if you have, let's say, a focus or a target group, and you have lower distribution costs, then from a distribution point of view, you have a bigger chance to survive. If you really have huge distribution costs, and you explain the whole world that those distribution costs will go down, it never worked in the past. So why will this work now? So I would say, to be seen what will happen. And what you often have that in certain phases, companies who are very old-fashioned are not able to raise money.
Yep.
And people who are transporting cucumbers from A to B are raising $1 billion. And then those people who have very old-fashioned business models, they don't understand the world anymore.
Yes.
And they will be right. And they will be proven to be right, but it takes time. And that's why you just have to wait until the tide goes back.
And this is why I say, you know, the having lived through this 20 years ago, cash burn is going to be the biggest metric to watch, right? Because like you said, those delivery companies are burning cash like crazy. And at some point that will lose favor and no one will want to fund them anymore. And the biggest thing to understand about VC, right? If you're VC dependent, you know, you're always, call it, 15 months or less away from being out of money, right? I mean, that's the game, is they want you to keep raising every, 12 to 18 months, which means if we get to an environment where VCs lose their appetite for the space, you're 12 to 18 months from figuring out a way to be cash flow positive or you're out of business, right?
But that's also, let's say, if VCs are really know the space, then they analyze your numbers without growth. And then they would say, okay, if we stop growth, then you're profitable at once. And then they know that you can survive. And it's exactly the other way around. If you have an enormous cash burn and you have to raise money to continue, then it's also very difficult. Or you have a software model or a Facebook or a social network or whatsoever. But otherwise it will be very difficult.
Yes. Look, people don't remember anymore, but in 2001, Amazon was down 90-something%, and no one wanted to buy it. No one would touch it because the cash burn was too high. So people make mistakes, and if you really have a good business and you have a Bezos running it, they'll figure out a way to solve it, right? Bezos figured out how to solve it. But not everyone did. There were a lot of web fans that didn't, right? But that's where, if you're saying what my advice would be to management teams today, certainly is
be a Bezos.
Yeah, exactly. That's one easy one.
That's it. Be a Bezos.
Right, there you go. Yes. You need to start thinking about, how will the environment change and what do I need to adapt? And obviously it's hard because it's not necessarily all in your control. If your VC still wants you to gun it and grow, it's hard to go to them and say, hey, I know where the future is heading better than you do. We need to change. That's not an easy conversation, right? But you need to at least start thinking about how you're going to make this transition. You certainly look at employee counts relative to revenue, and they're just crazy. Right? Like, so you probably have to think about things like, do we really need to be hiring at the speed we're hiring at? Things like that, before you have to do it against, when you don't want to, right?
I just kind of conscious of time.
Yeah, sure.
But Ian, this has been really, really interesting. And anyone listening, please comment or ask any questions. We've just at the tip of the iceberg, if you like. Thank you so much for taking the time to talk to Tom and me. And I wish you best of luck in your new venture. Keep the cool blog posts up. Again, I'm an avid reader if I understand half of it. And, be safe and see you on the circuit.
Thank you. Best of luck to you guys. Thanks for having me. I appreciate it.
Thank you very much.
Thank you very much.
Take care.
Have a good day.
Bye.
Cheers.